Welcome to the deep dive. Today, we're really getting into the weeds on the Q3 2025 earnings call. Came out after hours, November 7th.
Yeah, and this isn't just, ticking boxes on quarterly numbers. This is about a utility trying to navigate some really choppy waters, huge liabilities, complex regulatory stuff, and frankly, unprecedented spending needs ahead.
Exactly. So we're going to unpack that call. We'll look at the numbers, sure, the beat they reported. But the real question is why the stock dipped after they seemed to show good operational progress.
Right. The market seemed to say, okay, nice execution on the ground, but the big picture risks, still terrifying. That's what we need to figure out.
Okay, let's start with those headline numbers then. What did they report?
So, core earnings per share, 719 cents.
And that beat consensus.
By about 5.6%, yeah. GAAP EPS was 0.16, revenue $790.6 million. Looks okay on paper.
Okay. But you said the market reaction was muted, then down?
Muted right after the print, yeah. And then the next day, the stock finished down over 3%. It tells you investors kind of look past the beat almost immediately. They're focused elsewhere.
Focused on the structural issues. And I think I see a reason why, right in the core numbers. That headline EPS beat looks less impressive when you see the utility's core net income actually fell.
Exactly. It went down to $39.6 million from $43.7 million this time last year.
So what drove that drop if operations were okay?
Well, two main things, really. Less benefit from R&D tax stuff.
Yeah.
But the big one, significantly higher costs, legal, consultants, wildfire mitigation work, all that stuff is adding up.
Ah, okay. So the cost of managing the crisis, essentially.
Yeah. The cost of de-risking is hitting the bottom line now, even if the headline number managed to sneak past expectations.
That makes their liquidity situation absolutely critical then. Management spent a lot of time talking about financial flexibility.
They did. And they had some concrete progress to show.
Like what?
Well, first, they pulled off a $500 million unsecured debt offering. At the utility level, that's a pretty big deal. It shows debt markets are still open to them.
That is a strong signal, yeah.
And they also boosted their overall credit facility capacity, added about $225 million there.
So what's the total cushion look like?
You've got about $544 million available to the utility itself. And then combined liquidity at the holding company level is around $519 million. It's a clear move to build up reserves, to handle costs, and that first big settlement payment that's coming.
Okay, so they've shored up the finances somewhat. What about the operational side, the actual wildfire risk reduction?
They highlighted real progress there, too. So they got all their planned weather stations deployed.
Ahead of schedule, they mentioned.
Yeah, and the AI-assisted high-def cameras, too. Also ahead of schedule. Plus, they set up their own meteorology watch office in-house.
These are all steps aimed at proving they're changing, right? Lowering the actual risk profile.
Exactly. Every camera, every station. It's an investment aimed at eventually convincing the regulators, the PUC, that the risk is lower. That's the path, maybe the only path, to getting a better cost of capital down the line. And that whole new wildfire safety strategy, it's now with the PUC waiting for review.
Okay, let's talk about the elephant in the room, the Maui wildfire tort settlement. Still the biggest overhang.
Absolutely. Management said it's on track.
And the funding, especially for that first big payment.
That part seems covered. They've got $479 million restricted, set aside already. They don't expect to pay it out before early 2026, though.
Okay. And is there a key date for investors to watch?
Yes. Mark your calendars, or at least be aware of January 8th, 2026. That's the court hearing scheduled for the final class settlement approval. That's when we should get, real clarity on the total liability size.
January 8th, 2026. Got it. And what about paying for the rest of the settlement, the later payments? That's where the dilution fear comes in.
Right. That's going to be a mix. They flagged using debt initially, maybe some convertible structures, longer term,
right.
A combo of debt and equity. But, and this is key, it really depends on market conditions when they need to raise that money.
So a lot of uncertainty there, which feeds into the complexity.
Precisely. That capital structure uncertainty is a major reason investors are nervous.
Okay, so this brings us to the really big strategic questions. How do they pay for all this? The settlement, the safety upgrades. Let's shift to the regulatory side and that massive CapEx plan. Starting with this rebasing idea under the PBR framework. Can you unpack that?
Sure. PBR is performance-based rate making. It's the system that dictates how much profit, the return on equity or ROE the utility is allowed to earn.
Allowed, right. But are they earning it now?
No, that's the problem. Their costs, especially for safety and mitigation, are so high right now, they're actually not hitting their authorized ROE.
So they need to fix that. That's the goal of rebasing.
Exactly. They're trying an alternative route, working with the existing PBR parties. They want to reset their target revenues, essentially, get permission to charge more before the next big rate period, MRP2, starts on January 1, 2027.
Why before? Why not just file a standard rate case?
They want a new, higher starting point for revenues when MRP2 begins so they can actually start earning that authorized ROE again. They need to recover these huge costs.
That timeline sounds incredibly tight.
Oh, it is. It's really high stakes, this alternative proposal. It's due to the PUC on January 7th, 2026.
The day before the settlement hearing? Wow.
Yep. Back-to-back catalysts. And if this alternative process fails, they have to fall back to filing a formal, traditional rate case later in 2026, which likely pushes the start of MRP2 out, delaying that needed revenue recovery even more. That's tense.
Okay. Alongside needing higher rates, they also signaled a massive increase in spending. The capital expenditure guidance was huge.
Monumental, really, for a utility this size. Let's look at the numbers. 2025 CapEx expected around $400 million.
Okay. Manageable, maybe.
But then look at 2026, it jumps, projected between $550 million and $700 million.
That's potentially a 75% increase in 1 year.
Could be, yeah. And then look out further, 2026 through 2028, so 3 years, they're projecting total CapEx of $1.8 billion to $2.4 billion.
Billion, with a B.
With a B. That's for wildfire risk work, resilience hardening, repowering generation. It's a massive overhaul.
That scale is just staggering, especially compared to their current market cap. How do they even propose funding that?
That's the billion-dollar question, maybe multi-billion-dollar. It's precarious. They did mention one tool for part of it. For the 2026 spend, about $50 million to $100 million of it, they plan to use securitization.
Okay, securitization. Remind us quickly what that means in this context.
Right. So there's recent legislation that allows this. Basically, the utility can borrow money for specific big safety projects at a lower interest rate. Because the repayment is guaranteed through a dedicated charge on customer bills. It's supposed to be a lower cost way for customers to fund essential safety work compared to normal utility borrowing.
Got it. Cheaper borrowing backed by customer bills. Okay. So let's pull back. Management is showing better liquidity, hitting safety milestones ahead of schedule, yet the stock sells off. Why the disconnect?
I think the market is just laser focused on the binary regulatory risk. Look at the wider utility sector, the XLU ETF. It's been pretty stable, near highs, helped by interest rate outlooks, the AI power demand story.
Right.
This company's a total outlier. It's still down massively year over year, specifically because of these huge, unique uncertainties around regulation and the settlement. Investors are basically saying operational progress is nice, but irrelevant if the PUC doesn't approve the rates needed or the settlement blows up.
And the fact they still won't issue earnings guidance doesn't help build confidence, I imagine.
Absolutely not. They confirmed it again. No guidance until two things are settled. Final settlement approval and clarity on that rate rebasing outcome. Understandable from their perspective, maybe, but it leaves investors flying blind on future profitability.
Did they mention the bank stake? American Savings Bank?
Briefly. Still plan to sell the remaining 9.9%, maybe in the next 6 months, they said, but waiting for the right market conditions. Another moving piece.
Okay. Well, that sets the stage perfectly for our This Is Not Financial Advice segment. Given all this pressure, what's an outrageous but plausible idea?
All right, let's put on the hedge fund analyst hat for a second. Look, you've got this incredible density of catalysts hitting in early January 2026, the rebasing deadline on the 7th, the settlement hearing on the 8th. This is shaping up to be a massive binary event. The stock is trading like it's already doomed. That screams potential mispricing, or at least massive volatility.
So you're thinking a volatility play.
Exactly. Something catalyst-driven. Here's the idea. The January settlement straddle. You initiate a small, long position in the common stock now. Why? To capture some upside if the market is too pessimistic right now.
Okay, a small, long bet. But the risk is huge if things go wrong in January.
Right, so you hedge that and play the volatility itself. Buy an equivalent number of near-money straddles. That's buying both a call option and a put option, expiring in late January 2026.
Ah, so you profit if the stock moves big, either up or down. You're betting on the size of the move, not the direction.
Precisely. If the settlement gets full approval and the rebasing looks like it's moving forward smoothly, the stock could absolutely rocket higher. Your calls pay off big, covering the cost of the puts and the total premium, hopefully with profit.
And if it all falls apart, settlement stalls, rebasing fails.
Then the stock likely craters. But your put options explode in value, providing a substantial cushion against the stock loss and potentially generating profit on their own. You're essentially making an expensive bet that the market is underestimating how violently the stock will react to the January news, whichever way it goes.
That is definitely playing with fire. A true volatility bet. Okay, let's summarize our deep dive then. Q3 brought an EPS beat, technically.
Yeah, but driven by core utility performance that was actually weakened by rising legal and mitigation costs. So a mixed bag internally.
Management did successfully boost liquidity, crucially getting that $500 million debt deal done.
And they gave us those critical high-stakes dates for early January 2026, the settlement hearing and the rate rebasing deadline.
But the big takeaway is just enormous execution risk, isn't it?
Absolutely. Funding the rest of the settlement, funding that massive $1.8 to $2.4 billion CapEx plan, and most importantly, getting the PUC to approve the rate structure needed to pay for it all. Clarity on those regulatory outcomes is everything. That's the only path to a sustained re-rating for this stock.
Well, thank you for joining us for this analysis of the Q3 2025 earnings call. Definitely keep an eye on those early January 2026 dates. That's when the next chapter of the story really begins. Until next time, stay well informed.